Welcome to the daily update, where I'll go over the action in the market for Monday, August 5th, and then we'll see how things look for Tuesday, August 6th. As I get starting to record here, I have some massive noise that's going on around me. You might already be able to hear this in the background. And there will probably be times when I'm going to have to pause this video. I have no control over the noise that's being made, and it makes me lose my train of thought sometimes. So I apologize for that in advance. You won't notice the pauses, but there might be little gaps as I start and stop this from time to time. Wow, what a day Monday turned out to be. Didn't necessarily catch us off guard. We didn't know really what kind of magnitude this would have, but we saw the signs. That's why the approach that I use with technical analysis, called the consensus approach, that I get criticized for, because it's like, your videos are so long, you look at so many different things. Well, yeah. And looking at all those different things said, okay, something's not quite right here. First of all, we're switching over negative. And second of all, we're seeing some real imbalances here, especially between price and volume. And that kind of all came to head. There's a lot going on geopolitically right now. There's unrest in England. We've got the Olympics going on in France. There's all this drilling going on where I currently reside. We've got all the political things happening in the US itself. And then on top of that, a situation that we've been watching for quite a while in Japan, that started to unravel. And if you've been watching these videos for a year and a half, 2 years or so, I at times refer to this situation in Japan. Well, it's a little bit different than what I've been referring to, but it kind of fits into the bigger picture. And I'll go through and talk about that as we go through the video. But as negative as things look, and as pop news as it became, because everybody's talking about the stock market, they're talking about Japan, they're talking about how everything's going down and everything's falling apart. On the positive side, that's about when things are finished. This hasn't been happening in a vacuum. Well, actually, to take that back, it's been a bit of a vacuum. I'm having a hard time concentrating here. And where a lot of things just go unnoticed. I heard somebody say one time that how does a business go broke, or even how do people go broke? Well, it's slow, 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 and then fast right at the end. That's kind of what we've been seeing in a way with what's been happening in the markets. This was building up over a period of time. We saw this developing last week and a half. It looked slow, didn't look to be all that big of a deal. And then boom, it all came to a head on Monday. And now, are we finished? You could make a case for that. The Japanese market was up 10%. It declined, what, 13% on Monday? It got back 10% of that on Tuesday. The futures are up for the S&P right now. We are at potentially solid support. We had broken through some support levels, but we were able to get those back. Now, we are still negative, though. You can't take that away. To try to front run this and say, okay, I think we're done, I'm going to go in and start buying. Let other people take that risk. We look at the charts, we wait for confirmation to actually happen. I will tell you that the positions that I do, we were looking at least I was looking, and then I put this on the website, at getting into some bearish positions on Monday. I didn't do that because of where we ended up. I ended up just holding off on those particular positions. Okay, I do have a thing that I just talked about called the SPXInvesting Program. It's out there. It's still free. It's available for right now. Even when I lock it down, there's still going to be free parts that folks will really find beneficial. It'll be more of a summary in written form, and I'll have some charts and graphs, possibly even a short video that just goes through what happened. I don't really go into the analysis and commentary. I just kind of go over things. At least that's what I'm playing with right now. And this is probably going to take its own shape at some point in the future. But feel free to check that out. We had a great month in July. There was a week and a half where we kind of sat back and didn't do anything as far as positions. And see, I have the notes right here. we looked at doing 38 positions throughout the month of July, and this is just in the short term. I don't cover as in depth what happens in the intermediate and long term. Um, we ended up getting into 18 positions. We had one loss. Okay. And sometimes that's going to happen. And then there were 3 positions that ended up breaking even because my personal philosophy on this is if I get into a position and I start seeing a profit and then everything starts to shift and it comes back down, if I get back to the break even point where I once had a profit, I get out at that point. Now, if I had held on to those positions, yeah, they would have done really well. And the returns that we're getting are anywhere from usually the low end is about 20%. Sometimes when we have to close them early, it might be 8, 10, 15%. But these are, still really good returns. And it's all based on the S&P 500. Some of these we just carried for a few days and they were 60, 70% returns and with a very high success rate. So if that's something that is interesting to you, it doesn't look at NVIDIA. We don't look at the latest and greatest things. I don't treat the stock market like Las Vegas, where most people do. This is just a machine that I've put together over decades of doing this, where it's actually kind of boring. But what's so boring about having consistent success and then letting compounding really build up your wealth that way, super protecting yourself? Like I have a long-term portfolio that really started adding to those positions in October of 2022. What do I do when we get into positions like right now? You can set up protection. You can set up hedging. And I always have hedging in place. I watched everything on Monday and I'm just sitting back going, okay, no harm done here. No losses experienced here. Now, I'm not going to make any money on my long-term portfolio, but because of the hedging, it's going to replace what was lost. So when all this mess finally gets over, I get rid of the hedging. I use that money to replace what was lost in my SPY positions. And I'm at break even, where a lot of people are like, I'm down 5, 10, 20, 80%, whatever. I don't play that game. I'm pretty conservative with everything. And this is where I teach these things, is in the SPX Investing Program. And I have courses, and then we have opportunities to get together. There's a chat room that's available. I'm trying to make myself very accessible. And I believe, and I'm not trying to say this out of pride, I'm trying to say this out of confidence. This is the top 1% of programs that are out there, which means it's not going to apply to 90%, 99% of stock market participants who want the thrill, who want the casino type of an environment. If you're looking for something that's just conservative and laid back, this might be something that you really want to check out. Okay, and I already talked about the program here. All right, and then the daily video, what I'm doing right now is the real foundation of what I do. I put out a lot of information, and some people find that overwhelming, and I know people are busy. But if you want to be successful at this, if you want to see what was happening before it actually happened, you're going to need to dive into it the way we dive into it in this program. Okay, so let's go back and talk about what happened and then look at some charts. We had a massive gap lower. We ended up declining down to S3 at 51.80. Just remember a week or so ago, we were in the 5,500s, and now we're down into the 5,100s. We tried to bounce, but we couldn't even get back up to S2 at 52.62. Then as we got further into the day, it looked like things were stabilizing a bit, but then we ended up closing back down at S3. And I'm wondering, is that a stabilization point? And we'll kind of pick that out and analyze this as we go through the charts. We were down 3% here by the time we got into the close. And then just to make a little footnote here, one thing that I was watching, and one reason why I didn't get into any additional short positions, at least right now in Monday's session, is that we set the high on July 16th. Just like it seems like ancient history now, but it was just a few weeks ago. And on an intraday basis, we were getting close to that 10% decline. Well, all the machines on Wall Street, all of the money managers, all of the smart money, they saw this happening. And if we're still going to maintain a positive posture, that 10% is going to be when the smart money comes in and really starts to buy again. We don't really have a lot of evidence of that yet, Things did rebound in Japan. We'll have to see how Europe does. The futures are up for right now, but we need to see some more consistent follow through, especially how we look to end when we get near the close in Tuesday's session. But we didn't quite get down to 10%, but we were close. We were like 9.8% or something from an intraday high. On a closing high, we ended up being down 9.3%. Now, I use intraday highs because I use intraday statistics to determine what's actually happening in the market. But it's just easier sometimes to look at closing values here. And then we didn't fall below S3. I mean, we bounced around. It was pretty turbulent down there for a while, and we came back down and closed at that level. Is this a possible support level? We'll look at the charts. We see some other support levels and other indexes, and we'll see what that's telling us right now. We were way above average with volume, and we are now negative. We're negative in the short and intermediate term, but we are oversold and possibly at support. We don't know if it's actually going to be support, but the way things are coming together right now, we didn't. Most of the loss was from the gap from Friday to Monday. We came down, we tried to bounce back up and came right back down. There really wasn't a huge movement intraday in Monday's session. And it's about growth concerns now. All of a sudden, instead of bad news being good news, because that might mean that the Fed will lower rates to try to stimulate the economy, that seems to be finished for the time being. And now bad news is bad news. And this goes back to last week. They're blaming it on last week with where we had the ISM manufacturing came in weaker than expected. We had the jobs report come out weaker than expected. And now instead of bad news being good, it's bad news is bad. And oh my gosh, the economy is going to fall off a cliff and we might be headed towards a recession. We don't know that at this point. A lot of people are talking about that, and I could not believe, and I didn't get a chance to really tune into any. I don't watch much financial media, and I don't watch very many videos from other people. I've done this for so long, I can get the whole picture just by looking at all my stuff individually. But I was just kind of scrolling through X, Twitter, whatever you want to call it. And there was this bigwig economist who was coming on saying, yeah, I think today the Fed's got to come in and do a 1.5 emergency rate cut. And it's like, how did you get to be smart? How did you get to be well known by coming up with stuff like this? This is all emotion. There's no logic going on here. And it's just, and that's what you see. And I listen to a lot of news podcasts and different shows and things. And I really respect the people that I listen to, but when they start talking about the stock market, it's like all emotion based, all reaction, all, oh my God, the world's coming to an end. Instead of looking at the data, instead of looking at the charts and just seeing things as they unfold, not making emotional decisions, let the rest of the world freak out while we just sit back and just say, okay, yeah, we see what's happening here. We already saw it happening. And now we're able to benefit from that. I closed 3 positions on Monday with above my profit targets because of the gap down. And one was, let me look here. I don't have it on this particular sheet of paper right now. One was at 50%. The other one was at into the 60s. And I think another one was close to 70%. And these were positions I opened late last week that were already going to benefit from the market going down. And so that's when I get high strung about this, because there's this idea that you have to buy low and sell high and you can only make money when the market goes up. And that is just so not true. And that when the market goes down, you're naturally going to lose money. That's also not true. And I've said about my mission to educate people to say what you've been fed are a pack of lies. Joseph Goebbels would be proud. It's all propaganda. There are ways to take advantage, especially when we have all this information available to us now through the internet. If you can just get your emotions in check, which I do cover in the program, you don't have to be a victim here. You can be on the offensive and you can be a conqueror with no matter what's going on. And all you need to do is look at the S&P 500 to do it. Okay, why am I on my soapbox? I got drills going on over my head here. Okay, and so there are concerns now about the economy. Is this going to last? We don't know. We had a report on Monday that actually came in stronger than expected that maybe suggests things aren't so bad after all, that I'll go through. We have a list of geopolitical concerns. Okay, we've got Iran, who's threatened now to attack Israel, where I'm supposed to go to Israel in September. I was supposed to go last October, and then things happened there. Now we'll see if things happen again as I'm planning this next trip. So I don't know if that's going to happen or not. And there's a whole mess going on in England right now. And I even heard one person say it looks like England's going to have a civil war. Well, yeah, things are pretty tense there right now and not going really well. The reason why we pay attention to that is, and if you can hear the noise in the background, I apologize. Things that happen in Europe tend to precede what happens in the US. And of course, based historically on things, the US came out of England. And if they're starting to have problems there and we see other problems within Europe, is that eventually going to come over and be a problem in the US? We already have plenty of problems already. Is it going to escalate to an even higher level? And then we have the whole thing going on between Israel and Iran. And so it's a mess right now. The only good thing is my Seattle Mariners are still in first place. All right. I hang on to things like that and beautiful music. That's my happy spot. Okay, so we did see a global sell-off that really started last week. We saw this on the wall. This didn't catch us off guard, but it started, they say it was a sneeze or a cough in New York and it led to pneumonia in Tokyo. Okay, all right, that's kind of clever. But it did start with some economic weakness, and I'll try to go through and explain this here in this next point. Japan was down 12%. Okay, now they already gained 10% of that back by the time I'm recording this. That's why I'm a little bit later recording. I wanted to see what was going to happen there. This is called the US dollar to yen carry trade. And I tried to explain this in some website videos yesterday. A very simple way to understand this is like your bank. You take $100 to your bank and put it in your savings account, and they're going to give you a whopping 1/4% interest or 0.5% or whatever it's at these days. Well, in a real simplistic form, they're going to take that $100 that you gave them, and now they're going to loan it out to somebody else and then charge them like 10% interest or 5% or whatever the case may be. That is a carry trade. You're using something from one place that's costing you money to get more money in another place. And as long as the relationship between the two stays intact, everything is fine. Well, this is starting to unravel. They're raising interest rates in Japan, where they're doing the opposite of what the Fed's doing, possibly by lowering rates. Well, when they raise interest rates in Japan, that makes the yen more precious, to quote Gollum there. And so it's throwing out of balance this whole dollar yen relationship that have been making people a lot of money, because now the yen's going up against the dollar, which is going down. And so folks are freaking out about that. What had been their bread and butter for quite a while is now in danger. In fact, it's starting to fall apart. So they're having to unwind these positions. And this sends a tidal wave, not only through the Japanese markets, but Korea was down, Taiwan was down, Europe was down, everybody was down in Monday's session. And this has produced a real bounce with the yen against the dollar. And that's kind of the foundation. Now, another thing that we're watching for, and another thing that I've been looking at for quite a while with Japan, is they own the most amount of US treasuries. I believe, I don't know if it's total or if it's just outside the US. Even more than China, even more than Germany, Japan owns a lot. And those are set at very low rates. And if interest rates keep going up, at some point, they're going to have to sell those bonds. And if they sell the bonds, that's going to put bond prices down and interest rates up. And that could then bleed over into the US. That's more of what I've been watching lately. But what we're seeing here has to do more with the currencies that are going back and forth. All right, it was another broad-based decline. It was a global decline. And it's front page on the news, I'm sure, the top story and all that stuff. And that's where we take some comfort when it becomes pop news, then because pop news doesn't last very long. And by the time, if you're walking down the street and you see a friend and they're like, wow, look at the stock market today, that's about when it's over, is when it becomes part of their everyday conversation. Okay, then also over the weekend, it was announced that Warren Buffett has sold about half of his Apple stock. Oh, that didn't sit well. Now, I am not, and I think I spelled his name wrong. I think it has two T's there. I don't really believe in following gurus. And Warren Buffett, who's very successful, is somebody I've read his books. If he says something, but I don't do what he does when he does it. And especially after he announces that he already did it. Like Jamie Dimon and these folks from hedge funds and things like that daily. Yeah, okay, what they have to say is interesting, but by the time we hear it, it's too late to do anything about it. Well, that didn't stop a lot of folks from freaking out about Apple, and Twitter was a flutter with, oh my gosh. And then I also saw another tweet. I don't know if it's true. The guy from The Big Short apparently just made a massive purchase in gold, which could also be negative for the market. Okay, we have a long short-term oversold list right now. We have the ADX, the short-term chart. The red line is getting above 40, the Stochc RSI, the Williams percent R, the CCI 14 and 20, the stochastics, the rate of change going back 5 periods and 10 periods, the force index, the standard deviations chart, the slope oscillator, the boom indicator. We're way far away from the 20-period moving average, and our short-term RSI indicator. We also have a pretty long list in the intermediate term. Also, the ADX, the Connors RSI, the rate of change going back 20 periods, the ease of movement, and we've dropped now with the S&P McClellan oscillator, the boom indicator saying that we're getting far away from the 50-period moving average, the NASDAQ 100 bullish percent index, the Chaikin money flow, a smart money indicator, and the percent B, which doesn't tend to happen or even last all that long. I've changed this up a little bit. The scenario is that the Fed is still leaving rates unchanged for the time being, but economic growth concerns are starting to grow. Is this going to be the new story? Is this the new theme? Or is this just going to come and go? That's why I waited a few days to change this. And they're still looking at September. Now, the market is anticipating 100% probability of a cut. It's just, what is the amount of that cut going to be? 1/4%, 0.5%? If you listen to the guys on CNBC, the talking head geniuses, they say 1.5% now and 1.5% in September. It's just crazy. All right. I don't know why they even give these folks time. Anyway, and the dollar was down, especially when you look at it compared to the Japanese yen. But we didn't fall all that much. Now, during the pre-market session, I was watching a lot of things. I was watching Japan. I was watching the U.S. futures. I was always also watching interest rates, and they tanked. But they started to bounce back up. And by the time we closed on Monday, they were only down 1 from 379, dropped down to 378. Still below 4%, but way off. We got down into the 3.6s when things were not looking so good there overnight. Also, when this happened, the 10 to the 2-year, it actually went uninverted. But by the time we closed on Monday, it went back to being inverted again. The 10 to the 3-month, it still has a ways to go. And so both of those yield curves are still inverted. We are now extreme negative. This is potentially positive sign number 1, that so many people freaked out. We're now at extreme negative readings. We dropped from 27 all the way down to 19. Our trend is negative, and we're crossing above the moving average. So it's now a negative strengthening trend, but we're getting above 40 with the red line, but we still default to negative. Naturally, the bias is negative, and I've switched our momentum to negative. We're in a pretty solid negative environment right now until proven otherwise. All right, the economic reports that came out. This was the global U.S. services, and it came in at 55, which is above 50, showing some expansion, even though it dropped down from 56 that we saw last time. This was the one that came in better than expected. This is the ISM non-manufacturing or services that came out. Last time, this freaked out the market. It came in at 48.8. below 50, showing contraction. Well, this time it came in at 51.4, above 50, showing expansion, and even up a little bit from what they expected at 51.4. This is actually, if bad news is bad news and good news is good news, this should have been taken as good news. All right. And then just to let you know here, I have an intraday chart here where Japan fell, what did I say, 12% on Monday? Well, they've gained 10% of that back in Tuesday's session. All right. And then this is the ISM, where if we look at the total, we're bouncing up and going back above 50 with the blue line. We're also going up with prices. Now, that could be somewhat inflationary, but the market seems to be fixated more on growth over the last few days than it is with inflation right now. Okay, then we have, this is the second quarter tracking, is the first quarter earnings per share quarter for the other 493 stocks. These are the Marianne and Professor stocks. I've shown this chart before, but it's really the Magnificent Seven that are driving the earnings per share higher. And even though the other ones are positive, all of the rest of the stocks, they're still quite a bit less than the Magnificent Seven. Then consumer discretionary, their earnings per share, they've been coming out pretty strong, but we're not really seeing that in any kind of price action right now. And that's what they're highlighting down here at the bottom, where utilities have been coming in really well and also seeing a lot of love these days. And this is Deutsche Bank's inflation forecast still. We're right around in here where this black line is. They still see it going down from this point. Of course, if this gets to be going down too much, now you've got deflationary concerns, which are actually worse than inflation, even though it may not seem like it. All right, then the ISM manufacturing that came out last week, it's dropping down, but it's still below 50. Now we have the services ISM that came out in Monday's session. And then here, this is a little bit lengthy too with the Yardeni. It says, this morning, U.S. stocks and bonds were quick to price in Japan's stock market carnage overnight. The Nikkei fell more than 12%, and they are worst day since 1987. Okay, fine. And then the yen really went up against the dollar. This time, the crash was in carry trades, as I tried to explain. They're taking cheaper currencies and using it against a more valued currency. In 1987, it was so-called portfolio insurance that caused problems. That was where a lot of people sold naked calls and all kinds of stuff. The 87 sell-off was a quick one without a recession. Might be current. The sell-off, will this also be quick without a recession? You know, who was president in 1987? This was my third or fourth year as a teacher at that point. I really hadn't got into the stock market yet, but I'm driving to my teaching gig, and I'm hearing on the radio that the Dow at that point is the most focused, was just tanking. And then later that night, I turn on the news and they asked Ronald Reagan, who was our president, what are you going to do about it? And he's like, I'm a conservative. I believe in capitalism. I'm not going to do anything. Where now it's like too big to fail. You know, somebody comes in, the Fed's got to fix it. Nobody can be a victim anymore. But yet, at the same time, everybody is a victim. I mean, that's the kind of culture that has been really brought up in the US. And then Reagan didn't do anything. And then within, 8, 9 months, the market had recaptured everything that had been lost. And then we went on to have the magnificent 90s, which, of course, Bill Clinton takes credit for, and the birth of the internet and a lot of technological advances and so forth. Is that going to be what happens here? You know, it's usually when the government steps in and tries to do something, that's when things become worse. You know, in a pure capitalistic free market system, let the market work it out. Yeah, there's going to be some short-term pain, but it'll produce long-term gain. Well, we seem to have forgotten all about that. We want both the short-term pain to go away, and then when the long-term pain starts to happen, now we want somebody else to fix the problem for us. But anyway, why am I on this soapbox? I got all this noise going here. This is Japan, and this is after the close on Monday. It doesn't reflect what happened on Tuesday, where we're seeing the Nikkei, which is coming off of recent all-time highs, and here's the yen, which is really bouncing up against the dollar. Then it says, we're closely monitoring Japanese topics banks and insurance stock price indexes, which plummeted last night. This was Sunday night going into Monday morning US time. This evening, they've rebounded 10.1% and 14.5%. The markets must have figured that the Bank of Japan won't be in a rush to tighten further, given the adverse financial reaction to what is happening here. And so we're seeing this is the real tank that does not necessarily reflect the rebound that we've been seeing, at least going into Tuesday's session. Then we keep an eye on the Treasury market. It didn't confirm the weak economy scenario that was been being priced into stocks right now. This bad news is bad news. So the 10-year, we did get down to 3.67% when things were really bad. And then it's back up to 3.85%. And then we expected to climb back about 4%. That's pure speculation. This is an economist talking here. As the recession fears fade and investors rotate back into equities. And this is Edward Yardeni. He's just saying maybe this is a short-term blip that will quickly get dealt with. And then looking at credit, the yield spread, and I do have a chart right after this to show you where we did see a pickup in the spread, but it's not as wide as it should be. And this is his chart right here, showing the VIX right here. And is it right here? Or no, I show this in the weekly video. This is the spread between risky and not as risky bonds. Well, if you look at the inverted version, yeah, we picked up here, but okay, we'll be watching this to see, is this going to start to come back down? And look at the VIX. Oh my gosh, there's a whole book you could write about how the VIX reacted on Monday. But yeah, this is picking up, but not necessarily, we just want to watch this going forward. And then the VIX itself, my gosh, we were down in the 12, 13 range there. Well, it got up to 65. Okay. And of course, this is what the non-financial people, the news people that I listen to, this is what they're focused on. VIX got up to, first they try to explain what the VIX is and they usually get it wrong. And then they say, then it spiked up to 65. Well, it got back down to 39, which is still stinking high, but way off of what it had been before. Okay, and then momentum, which, okay, it had been showing some weakness here, and I have some charts to show you of that. And this is the momentum. This is going back 200 periods. I show a 250 period rate of change way that I look at momentum over the weekend. Okay, and then the Senior Loan Officer Optimism Survey, or SLOOS, gotta love that. It was pretty upbeat, showing that banks are no longer increasing rates on loans. Loan demand is starting to pick up, and the few banks are tightening their lending standards. None of this is consistent with an economic recession. I didn't hear about anybody but here being reported on this. And so if you look at this chart, it's just not necessarily suggesting things are falling off a cliff. Now they could, and Edward Yardeni could be wrong here, but at least we're looking at some charts to justify things instead of these, offbeat conclusions that aren't really based in fact and that are in esoteric theory or something. Markets were quick to price in up to 200 basis points of the Fed over the next 12 months. We're going to cut rates 2% just because of one bad day. We don't think the Fed will be that responsive. Okay, we're sticking with just one rate cut in September for the rest of this year. No recession, no bear market. This too shall pass, which is a famous saying that my father used to tell me all the time. Okay, I didn't want to listen to the nonsense on Twitter, so this is actually a screenshot from another news site that I go to. This is a concern where Israelis are bracing for massive Iranian missile attack that could come at any moment, and that could escalate things. So, yeah, all right. Now, looking at our chart here, you can see the huge gap down from Friday to Monday, and most of the damage was done right at the open. We tried to bounce back up, never got up to S2 before coming back down and settling at S3. Now, yeah, that's negative, and we were down 3% for the S&P, but we didn't fall off a cliff. We just didn't keep going after the market opened, which you could also take that as positive. And of course, we saw the huge move down here before the market opened. But when you look at this and then you see the bounce in the futures in the initial overnight session, we are seeing some improvement, but everything got hit. Growth, value, everything got hit in Monday's session. But the red line is still above the blue line. This has been a concern to us when we look at intraday growth versus value. We also didn't really fall off a cliff here. When we look at S&P growth to value, we were down, but it wasn't just a one-way ticket without any bouncing. So we were down 3.28% with growth, 2.36%. See how everything just got smacked? We were down less with mid-cap growth, and we were down less, over 3%, but less than small cap with small cap growth. So we bounced up a little bit with small cap growth to value. We actually leveled off with mid cap growth to value. We ticked up just a little bit with S&P growth to value. This is something that I've been trying to point out, and it could be rather negative, in that we came down to this 250-day moving average and bounced up off of that. Well, we were down to the 250-day moving average again, and it looked like maybe we had a shot at bouncing up here. No, we've now dropped down below it. We'll be watching this to see if that continues. Discretionary, yeah, just falling apart. We had staples and discretionary down, but discretionary was down even more. Large cap growth getting down close to that 200-day moving average. But notice here, we opened here and we closed well off of the lows. Also going back up as the large caps have been holding up a bit better than the small caps. And then the Wilshire, which this is Monday's, actually this is Friday's, this is Thursday's chart. So I'll hit this one later. That's an erroneous chart. This is the ADX in the short term, where we're turning and showing a strengthening trend, but the red line is getting above 40. And that's when we start to get extreme. Doesn't mean we'll stop. It just means that, okay, we notice this and we're aware of it, that this downward move may be exhausting itself. And in the short term, we're also above 40, but we are clearly negative. And volume was just really, really high as everybody decided to freak out. What happened to the dog days of summer? The NYSE volume, it's above average. And what NASDAQ volume, above average. Okay. Then sentiment, well, we really just came crashing down here. Now, this is a weekly chart, and it probably doesn't, in fact, it won't reflect what happened on Monday, because this is put out over the weekend. It was put out actually before the market opened on Monday's session, but we dropped from being extremely greedy over here into the neutral camp. And then we saw a bit of a tick off with insider buying. And even insider buying, the ETF got smacked in Monday's session. The Ulcer Index actually ticked down just a little bit here, believe it or not. And this is the VIX. My gosh, it's like fly me to the moon. It just really shot up. And we closed well off of the highs, but still, when we look at the closing value with the line chart, it's just way higher than what we've seen. And also the VIX of the VIX is just shooting up right now as well. And then looking at this, this is before, and I go through a version of this chart over the weekend. This is before Monday's session. This is a 3-month average of the VIX, where it was getting to a really low reading. Well, it's not going to be that way much longer. Okay. And then they do a relative measurement here to the VIX, which is similar to what I do when I do a ratio with this. Okay, and then the VIX is up 25% from July to November of presidential election years. Well, it's up a lot more than that now. It was up like, what was it? Would they count 130% at its high? The VIX was up from Friday to Monday. Well, we do see a pickup in volatility, and that's the historical seasonal chart that we've been following. Also, we look at the volatility between stocks and bonds. I usually only show this in the deep dive video, but this thing just skyrocketed up as stocks were being more volatile. This also, I often show not in the daily video. We just see how volatility picked up. Even bond volatility went up, and we're seeing a really high correlation between the volatility of each right now. And the momentum just shooting up here with the MACD. We're also extreme with the RSI 9 when we look at the VIX. And we actually ticked down on a closing basis with the equity put call ratio. That's interesting to have the huge decline that we saw and folks actually bailing on their puts. Maybe this is over. Maybe it's not either. All right. But then when we look at the 5 period, we're still going up, and the 10 period is also still going up. And this is the seasonality that possibly we're coming into, where we see a higher VIX, which means more volatility in stocks, which typically means a downtrend. Okay, then we just kind of ticked up a little bit here with this fear gauge, and we just shot to the moon with this other fear gauge when we look at how fear really increased very quickly. We're coming down with our risk on to risk off ratio, you think? Folks are bailing on stocks, at least in Monday's session, and that's pushing this ratio really down. And maybe this was a little bit of a foretell. We had a really high reading back in July with the volatility risk premium, and then it's just been dropping lower. It picked up a little bit, but nothing all that great in Monday's session. And then we look at the euphoriometer here. This is looking on a global scale, and they combine different things together. Well, this is probably going to come down now as we were getting pretty high readings. This is also a sentiment gauge. And then you look at the advanced decline line. Yeah, it was down, and it was down even more based on volume, which is a negative divergence, but we're still above the moving averages. We look at the new highs, new lows. Yeah, the new highs dropped off. We saw a bit of an expansion of the new lows. We're rolling over a bit with the 5 period, and we had been going up, but now we're turning down with the 10 period. But we're not seeing anything. Now, on the positive side, we're not seeing any real internal weakness. But at the same time, that means maybe there's more weakness to come. So there's a positive side and a negative side to take from this chart. We declined in the short term, and we're just barely hanging on to being positive in the intermediate term with the advanced decline ratio. We're getting really extreme here with the accumulation distribution. That's when you look at the boom indicator. But look at here. We're below a declining moving average, but you notice how the accumulation distribution actually went up a little bit? Isn't that interesting? And we also ticked up, even though we're extreme negative with the Chaikin money flow. Isn't that interesting? And even in Friday and Monday session, the Chaikin oscillator is now going up after being extreme. Isn't that interesting? Then on a one-day basis, we look at the advanced decline ratio. Yeah, we probably overdid it. So let's hope that Tuesday's a little bit calmer. And we just fell off a cliff here with the cumulative NYSE advanced decline line. But when you take the regular advanced decline line, yeah, we fell, but we're still above the moving average. Also fell, but still above the moving average with this other NYSE advanced decline line. We've been falling with common stock on the NYSE based on price, falling with a little bit more velocity here based on volume. This is what we've been seeing. And we also fell with S&P cumulative advanced decline line based on price and falling with a lot more velocity based on volume, which is what we've been seeing. And I would take that as a bit more negative right now, unless it's some kind of a washout decline. And the NYSE advanced decline line is actually holding up better than the S&P. Well, everything's coming down, but the red line is still above the bar chart. And yeah, we're seeing some weakness here, coming back down to the moving average with the NYSE common stock decline, but still above the moving average with the S&P, a little bit below with the mid caps, and still a little bit above with the small caps. Not necessarily falling apart, at least yet. But when you look at the chart, oh my, look out below. We just went way below the 100 period moving average, which I don't have on here. And we're actually in danger of possibly coming down to the 200-day moving average. All right. And then the rate of change from Friday to Monday. And Friday was a bad day too. And then we take the rate of change in addition to that from Friday to Monday. Yeah, I think we went down pretty far, pretty fast. The 5-day rate of change is also extreme, and the 10-day is also extreme. And later on, I'll show you the 20 is extreme too. And so we're going down when we look at the 20, 50, and 200 period moving averages. We are extreme and have been extreme for a few days now with the Stochk RSI, also with the Williams percent R, the CCI 14, and the CCI 20. When we look at the condition of the 20 period moving average, it's just not looking good right now. We're below both lines and everything is going down at the present time. And we're just looking back in fond memories of the 20 period moving average here, the simple and exponential version. We're extreme with the stochastics in the short term, intermediate term, and we're starting to roll over, but not extreme in the long term. The force index, whoa, haven't seen a reading like that in quite a while. Very extreme negative. We're down into the -3 channel with the standard deviations chart. So we probably overdid it that way. Balance of power is still negative. We're actually seeing an extreme negative reading with the Connors RSI, which we don't see all that often. And the go, no go, gee, what do you think it is? It is saying no go now. All right. And we're dropping below the lowest low value as some damage has definitely been done. We're also seeing some damage done to the 50 period moving average study here as all the lines are going down. And we thought after Friday's session, I wonder if the 100 period moving average will provide support. That was the big thing through all the videos I did. Well, not so much. We've actually dropped below that now. And the TTM squeeze continues to go down, dropping below the black line. So to give you a little bit more context, we're getting, now we could go further, and I put this black line on here, so there's no magic being done. I just kind of eyeball this and go, okay, that's a good spot where we get extreme negative. Well, that's what's starting to happen here with the TTM squeeze. We fell below the 100. We have not come down to the 200s yet, at least for the S&P. And then anchored moving averages. Couldn't use these for a long time because we just kept going up and up. We fell through this orange line. We fell through the blue line. Based on this low that we set back in October, this would be the next area that we might watch as potential support. And here's the rate of change going back 20 periods, also getting rather extreme. And we really are moving fast now, so the standard deviation is picking that up. We could possibly getting extreme with the ease of movement. It's really negative now. We're declining with the Erin indicator. We're actually just barely on the border with extreme negative when we look at the S&P McClellan oscillator. So now, and we were seeing this negative divergence before, where we were still going up with price. We were going down based on volume. Now price is starting to roll over and turning negative, and we're actually dropping below the midpoint here based on volume. So that's more negative. And we're not extreme yet with the NYSE McClellan oscillator, but we've dropped below zero. So now we're starting to roll over with the summation index based on price and volume. And notice how the volume is going down a little faster. We were seeing a mixed picture over the weekend with the Swenlin trading oscillator. Now we've dropped below zero based on price and volume. And we're starting to come down to the midpoint here with the PMO. We finally crossed over negative based on price, where we have been negative based on volume for quite some time. We're almost getting extreme here with the PMOs that are rising. We're declining with the buy signals. We're declining with the PMOs that are above zero. And we're negative with the Elder's Impulse system. We're negative with the parabolic SAR. And is it the next chart? Well, there's one chart coming up here where the SPY was just causing some problems here. We had one day of a dot underneath, and now we've had the last 2 days with the dots on top. That is negative. We're starting to get even more extreme negative with the slope oscillator. We're dropping more below the midpoint with the MACD and negative. So across the board, short, intermediate, and long term, the momentum is negative. We are declining, but still rather neutral with the Sean trend meter, and we dropped below 50 with the bullish percent index. This had been hanging in there and looking a lot better. It kind of broke down in Monday's session. And we also dropped below 50 with the NYSE bullish percent index. After just 2 or 3 days ago, we were getting an extreme positive reading, suggesting good momentum with the broader market. Well, didn't happen on Monday. And we're negative and almost getting extreme negative with the NASDAQ 100 bullish percent index. We're declining with the money flow. We rolled over after we had been coming up with the ultimate oscillator, but now we're pointing a little bit back down again. The vortex is negative with the red line going up. We drop below the midpoint with unbalanced volume, so that's turning more negative there. The Copic curve is also saying the momentum is negative. We're below 50 with the 20-period moving average steady. Our study here is just not really helping us right now. We're dropping below 50 with the 50-period moving averages. We're also dropping below 50 with the 100-period moving averages, and we're declining but still above 50 with the 200. We're waiting to see if something's going to happen here. The mass index. We have 2 out of the 3 signals that have been triggered since we went above the red dashed line and the blue line. When this comes back down and crosses below the red dashed line again, that suggests a switch, a reversal of whatever was happening that caused this signal. Not perfect, but something we still watch. We are extreme with the boom 20 and the boom 50. We're declining, but still above zero with the boom 200. And we're outside of the lower Bollinger Band. We tend to not have this last very long here. Either price is going to have to go back up, the Bollinger Band is going to have to catch up, or a combination of the two. We're almost extreme with the RSI 14. We are already extreme negative with the RSI 9. And we're coming down below the cloud now with the Ichimoku cloud. And I'd been pointing this out where the blue line was below the red line. We were in the cloud. Send in the cloud. Isn't that a song? I know. Send in the clouds. Clowns. And the green line's been going down, but the fact that we're dropping below this is negative unless we can come back quickly and regain this area of support. This is the other one where the parabolic SCR, it was still giving us a positive signal after Friday. Well, it kind of changed its mind now, and it has the dots on top. So we're seeing more confirmation there. But in the broad market, The 5-period moving average of the highs minus the lows were declining, but still above zero. And then looking at this, we were concerned that we dropped below R2. Now we're coming all the way back down to R1. Could this area provide some support for the S&P to bounce up off of? Keeping an eye on the fib retracement just in case we get down to this level here. And we've pretty much exhausted all the fib extensions to this point. So at some point, I'm going to have to wait for another low and high and then do a fib extension based on that, because this chart is pretty much useless right now. And this is what I was watching on Monday and why I decided not to take on any more bearish positions. From the high, and I do this on an intraday basis, from the high on July 16th until we were coming down close to the 10% level. And as I said earlier, I'm not the only one seeing this. The smart money out there seeing this too. We got down 9.72%, but I do this measurement, so it's probably not exact. But we were getting close to that 10% level. We were also hitting the S3 level for the S&P, and other charts that I'll show you going forward from here. We were also hitting some significant points. And so that's why I decided, okay, I'm not going to take on any more short positions until things calm down a bit here. All right, we are declining on a trend basis with the Heiken Ashi, with the Kegi chart, with the Renko chart, and the 3-line break chart. And if you think that dance was exciting after Friday, the double bottom breakdown, ooh, doesn't that sound exciting? We have even more zeros that have been drawn here, so the dance is getting even more intense. All right, we are no longer extreme when we compare the 150 and 200 period moving averages. And we're dropping down after being extreme positive here with the 10-day average of the S&P 500 highs minus the lows. We've been hanging out here, even though we were seeing some weakness. It finally gave up a bit of the ghost on Monday. All right, and we're negative in the short term. We're negative with the mid caps and the NASDAQ 100 right now. And of course, stocks are negative in the short term. Bonds are just seeing a lot of love right now. Commodities are a negative across all time frames, and the dollar is still negative in the short and intermediate term. Somebody's asleep at the keyboard here at Decision Point. They're just not updating this chart. Nothing but red. This is crimson, baby. If you're from Alabama, you really like this chart. Okay, and all the sectors also red. So with tech and financial got hit too, but tech really led things a lot lower. Real estate, which had been doing okay, everything got hit in Monday's session. It's like, give me something to sell. I don't care what it is. And we did drop negative here when we look at the new highs minus the new lows on the NYSE. And we're declining with both the S&P and equal weight S&P. But we didn't see much of a change here, a little bit of a decline when we do the ratio between the two. We dropped below the 50-day moving average with the Dow. We're negative with the Elders Impulse system for the diamonds. And we came down, we actually opened below the 200-day moving average for the NASDAQ, but we're able to close up off of that and above this S2 level. Yeah, that was not a good start, but a better finish. And we look at the NASDAQ 100, also opened below the 200-day moving average, closed up off of that. But we're still negative when we look at the trend with the Elders Impulse system for the Qs. And we're negative with the momentum for the NASDAQ 100. But are we getting a little too negative here? We haven't seen this low reading since 1973. I don't like it when folks do these comparisons here. And we did open below the 200-day moving average with the Qs, but we're able to close above it. Another concern is we're seeing the 20-period moving average coming down and potentially crossing below the 50-period moving average. And all the fib extensions here are pretty much useless now. Now you know why I don't use these all that much. I'm still going to use them, and I'm going to try to find interesting ways to give us insight with this chart. But folks that use these a lot, it's like fortune telling. It's interesting to look at, but I don't bank on them. Small caps. Now, this is interesting, okay? We came down to the 200-day moving average of the small caps and then bounced up off of that. Sure, they were down 3.25%, but is this where the support is going to come from? Are the small caps? If we're actually seeing economic weakness, if interest rates are going down, now that could also be negative for small caps, but interest rates going down could be positive. This is where we hit the 200-day moving average. Now, we'll have to see. Where do we go from here? All right. And then looking at the Russell 2000 small caps, coming down and almost getting extreme with the RSI, coming down to the 200 period moving average here too. Interesting, but the momentum is clearly negative. We're negative with the Elder's Impulse system for the small caps. We came down a little bit below the 200-day moving average with the mid caps, but closed up well off of that. But we're negative with the Elder's Impulse system for the mid caps. Here's the real chart of the Wilshire. I decided to put it in a different place and I forgot to delete the other one. We had been holding out here at the 50-day moving average, which was suggesting the broader market was hanging in there. On Friday, we dropped below that. We dropped below that again here. So this is actually more negative. And we're also holding out some hope here with the total US stock ETF. We fell below the 50-day moving average on Friday, and we're just further down after Monday. And we're seeing a real spike up here with the staples to tech ratio as everything got taken out and shot on Monday. The dollar is declining, even though we haven't seen a death cross here with the trend. The FANG index also bouncing out the 200-day moving average and closing up off of the low here. That could be encouraging. Apple, right in between. And after the Warren Buffett thing, and everybody freaked out and said, well, if Warren Buffett's selling 3 months ago, I better sell today. And so that's why we saw a really lower open, but it actually came up well off the lows, but not above its 50-day moving average. Amazon just kind of sank and the piranhas were eating it, but it did also closed up off of the lows. Amazon or Microsoft also was down below its 200-day moving average and still is. So we'll have to see if we see a bit of a bounce back there. Meta was down just a mere 2.5% and in between its 50 and 200-day moving averages. We are declining here with Google, but still above the 200-day moving average. Nvidia, which aren't you glad you took Jim Cramer's advice and bought it last Thursday when he said it's cheap? Well, it's even cheaper now. And those people that listened to what that clown said are even broker now. And I don't mean stockbroker. Well, I guess stockbroker would make sense. All right. And then Tesla, after giving us a golden cross here, is now falling below both moving averages. Netflix was also down, but still above its 200-day moving average. Looking at this small cap to tech ratio, it had been coming up as we're seeing more favor in small caps. This ratio was actually up just a little bit in Monday's session. And then the relationship between US stocks and world stocks, yeah, everything crashed on Monday. I shouldn't say it. It's not a crash. A crash is out of control. And I know the perma bears, they're going to talk about, the end of the world and all that stuff, but we're seeing a little bit of a pickup in the short-term correlation and the longer-term correlation. We want to keep an eye on oil, mostly for right now due to geopolitical things going on in the Middle East. But we're just continuing to go down here. We're getting into the lower 70s. If this really starts to spike up because Iran is starting to attack Israel, then that could be negative for stocks. And then looking at the massive decline in the 10-year yield and the massive advance in the 10-year based on price, and looking at some of our ratios that we've been following. We want this to go down. It's now going up when we look at bonds to stocks. And broad market also seeing some real weakness here on this ratio, weakness with the broad market to bonds, weakness with the tech sector to bonds actually falling below the rainbow. And then we're seeing a real shift here as folks are getting out of junk bonds potentially and getting into more conservative bonds, thinking that interest rates have possibly topped out. That's when we see this ratio going down. 1 to 3 month cash versus 3 to 7. We want to see this going down, but not the context of what we're in right now, meaning economic weakness. We're also seeing the 1 to 3 year and 3 to 7 year declining. And I usually just show this over the weekend because I would have shown the same chart for over 2 years now. With the 10 to the 2 year, we briefly went back to being regular, but then we are still inverted. We still have a ways to go with the 10 to the 3 month. All right, then looking at the Qs, the bonds coming down. Is this a possible area of support? Coming down to the 250 period moving average with this ratio. And the soft landing scenario, that seems to be in doubt right now as we're slicing through the rainbow. Are we going to find some bounce at some point here? And looking at tips, which that's what folks get into when inflation is a problem and interest rates are going up. And when this is going down, that should make the stock market happy, but not in the context that it's currently starting to adopt. And then the Eurozone, which is just falling completely. This is like Dorothy is somewhere under the rainbow right now when we look at Euro stocks versus 3 to 7 year bonds. Then we look at home construction, which had been holding up quite well, falling back now, but still at the upper end of the rainbow. And then our growth to value ratios just suck right now. The Qs to S&P, discretionary to S&P, large cap growth to large cap value, all going down. Large caps, mid caps, small caps actually ticked up, but still below a declining moving average. The S&P to utilities ratio is going down. That's negative. We want it to go up. And we're falling here with the 2-year treasury yield. But again, given the context, that could be more negative than positive right now. And we're turning negative here with our advanced decline ratio based on 19 periods based on price and volume. And then staples to S&P, we want this to go down. It is shooting up fast. Did we get a Hindenburg-Ullman confirmation? No. Not yet, but the permanent bears will tell you, oh, it's almost there. Go ahead and take my word for it. We'll just trust that it is. And we'll have to see. We won't get Monday's results until after Tuesday. All right, but we're getting lots of confirmation here with the NASDAQ, but we had it all along the way, and it didn't really mean much. All right, so what's our outlook for Tuesday? We are going to see earnings reports still coming out, but it's going to slow down. We're kind of beyond, at least for the S&P, 78% of the companies have already reported, so it'll be slowing down a bit there. We are negative, but, and I should put a question mark at the end, and I do later on. Are we finding support now? You could make a case for that, but we want to let the market prove that to us. We don't want to front run this. There are going to be people that try that are going to get decimated if we're wrong. So I like to look at the charts and have it prove itself to me. We're only going to get trade balance. So there's really no economic reports coming out on Tuesday. The whole mess of things going on in France with the Olympics, with the US election, with the unrest in England, with the potential escalation, it might have even escalated since I've been recording this, in the Middle East between Iran and Israel, and the whole election thing. Things are just crazy and probably going to get crazier. And then on Wednesday, well, not really much. We're going to get weekly jobless claims. I actually have that highlighted because that's one of the bigger reports right now. Here's the economic calendar for the week and the previous readings and the forecasts. Seasonally, yeah, not really much of an edge, but we are neutral to positive for August 6th. Tuesday is kind of flip of the coin, whether it's positive or negative. And then when the president isn't running for re-election, we do tend to be positive, but maybe we're going through one of those little down times right now. And then this is interesting, where the seasonality of the market performance, this is looking at the Morgan Stanley CI, I forget what that means. The best months are in April. Well, April sucked. We ended up really going down. And August is supposed to be one of the better months, but when you look at it here on this chart, it's more negative, where September tends to be more negative. Did I say that right? This is what I mean by looking better on a seasonal basis in August, and we see more weakness in September. Also, this shows where September tends to be weaker. But during an election year, tends to perform quite well. But this is a different election than what we've seen before. All right, the warning signs. We're keeping an eye on these defensive sectors, even though everything got smacked on Monday. Growth to value, discretionary to staples, not looking good. We're going up with the 5 and the 10-day equity put call ratio chart. Accumulation distribution, when we look at the boom indicator, we're actually looking a bit extreme negative, but we're also ticking up a little bit. Chaikin money flow, ticking up a little bit, but could be considered extreme negative. And the Chaikin oscillator is actually going up. Ooh. All right, then we look at the NYSE and S&P McClellan oscillators and summation indexes. They are both over here on the negative side now. And this should be not mixed. We're just flat out negative with the Swenlin trading oscillator. The bullish percent index for the S&P, the parabolic SAR, the ease of movement, but maybe extreme there. The money flow, the vortex, our oscillators, the ultimate oscillator, even though it had been going up a little bit there. And the Copic curve is negative, the bullish percent index for the NYSE. And we're seeing possibly extreme readings when we look at the momentum for the NASDAQ 100 and the bullish percent index. Okay, positive signs. Very short list, and I had to kind of use some creativity here. We were down with the advanced decline lines, but not necessarily falling apart, at least yet. And the financial sector is still positive, but now it dropped below its 50-day moving average. Okay, our conclusion. We're negative, but we are oversold and probably over freaked out at this point. Are we finding support right now? In the short term, we are oversold, but still negative. We're negative in the intermediate term, but oversold. In the long term, we are still positive. And if we start dropping more, we're really going to be watching that 200-day moving average. Thank you. Thank you for putting up with my ramblings and my entertainment rhythm section in the background. I hope that you have a really good day, and I will talk to you in the next video.